Right. Roughing it. I know you mentioned that Japan only had one more time to intervene, and yet they still being able to keep it stable. Can you please explain how to me? Yeah, absolutely. Good to see you, by the way, ma'am. So they're starting to repatriate assets. What that means is they're buying back bonds from people that are foreign from them, and they're driving domestic banks to do that. So they're not having to print money to do it. So as more people buy bonds, it drives the price down. It also strengthens their currency because now bond yields, their currency goes up in comparison to the dollar. They haven't intervened by printing more money or selling off more treasuries. They've intervened to the tune of like, it was like $73 billion worth of intervention in the last couple months here. They're really out of that type of intervention. Their last ditch effort here was to repatriate assets and drive demand domestically for their bonds. We've seen some of that. If they raise interest rates, that's going to drive it substantially more. As the interest rates for their bonds continue to climb, people will sell off foreign debt and rotate into their own currency and their own bonds, which will strengthen their currency and their bonds. And also stabilize their markets, which they need to do because it's skyrocketing right now in the yields. So for them, they need to be around 2% on their interest rates. And just so you guys understand like how bonds work, I'm not the bond king. If you guys want to go follow him over there on YouTube, he's also very good at explaining all of this. When you have a 1 year, a 2 year, a 5 year, a 10 year, a 30-year bond, it's priced at the interest rate that the market believes the interest rate is going to be at that point currently. So it's a forward look on where they think the interest rates are going to be over that duration. As it sits right now, the bond yield on the 10-year treasury in Japan is 2.7. Their current interest rate, I think they came up to 1 with 25 basis points that they raised at one of the previous meetings before they held here recently. That's not enough. There's a large discrepancy between where they currently are and their interest rates at 1% and where their 10 years trading. And people believe that over the next 10 years, their interest rate's going to be closer to 3%. So that's why they're pricing the bond where they are. So anyway, so just as you look at bonds and you guys, as you diversify post-price appreciation into some of these other financial products in order to generate dividends and returns and, hedge and do other fun stuff to preserve your wealth,